Are you curious about real estate? In this video you will learn and understand the market, investing, and strategies for success, so let's start. Real estate has long been regarded as a tangible asset class, offering stability, growth potential, and opportunities for both personal wealth creation and business development. Whether you are a seasoned investor or someone looking to dive into the world of real estate, understanding the nuances of the market, the investment opportunities, and the challenges involved is essential. In this video, we will explore real estate from various perspectives, answer important questions about the industry, and offer insights into strategies to succeed in this field. Real estate versus stock market. One of the most common debates in the world of investing is whether real estate or the stock market offers better returns. Both asset classes have their pros and cons, and understanding these differences can help investors make more informed decisions about where to place their capital. Real estate. Real estate is a physical asset, meaning it has intrinsic value and can provide consistent cash flow through rental income. Additionally, it can appreciate in value over time, especially in prime locations or areas with growing demand. Real estate can also offer tax advantages, such as depreciation and the ability to deduct mortgage interest. Stock market. The stock market, on the other hand, offers the potential for high returns in a relatively short period. Stocks can be more volatile than real estate, and investors may experience significant gains or losses based on the performance of individual companies or overall market trends. Ultimately, choosing between real estate and the stock market depends on your risk tolerance, investment goals, and time horizon. While real estate can provide stability and long-term growth, the stock market may offer more liquidity and higher short-term returns. Real estate as a tangible asset. Real estate is a physical asset, which means it is stable and has intrinsic value. Investors can benefit from its tangible nature, appreciating property values, and the potential for consistent rental income. Over time, well-selected properties generally increase in value, allowing for capital growth. Stock market volatility. In contrast, the stock market offers the potential for high returns but comes with volatility. The value of stocks can fluctuate rapidly, influenced by company performance, market conditions, and global events. Investors may experience substantial gains or losses, making it riskier for those with lower risk tolerance. Real estate versus stock market. Which is better? The decision to invest in real estate versus the stock market is highly individual and should be based on your financial goals, risk appetite, and investment preferences. Real estate is a more stable investment, with less volatility and a higher degree of control over your investment. It's ideal for those seeking long-term wealth generation through steady cash flow and appreciation. Stock market investments can yield higher returns in a shorter amount of time but come with increased risk. It's better suited for those willing to take on more risk for potentially greater rewards. Stable growth through real estate. Real estate investments typically offer stability with lower volatility compared to stocks. Investors benefit from steady appreciation in property values, and rental properties can generate consistent income, which is less prone to the market's daily fluctuations. Higher returns with stock market. The stock market, on the other hand, provides opportunities for higher short-term returns. It is highly liquid, allowing investors to quickly enter and exit the market. However, the potential for quick gains is often offset by greater risk, making it more suitable for investors willing to tolerate market swings. Real estate like-kind exchange. A smart tax strategy. A like-kind exchange in real estate refers to a provision under Section 1031 of the IRS Code that allows investors to defer capital gains taxes on the sale of a property, provided the proceeds are reinvested into a similar property. This strategy can be highly beneficial for investors looking to expand their real estate portfolios without incurring immediate tax liabilities. For example, if you sell a rental property and use the proceeds to buy another investment property, you can defer taxes on any capital gains until you sell the new property. This makes it a powerful tool for real estate investors looking to scale their holdings without reducing their profits through taxes. What is a like-kind exchange? A like-kind exchange, also known as a 1031 exchange, allows real estate investors to defer capital gains taxes on properties sold, provided the proceeds are reinvested into similar properties. This provision, under the IRS Code, encourages reinvestment and allows investors to grow their portfolios without losing profits to taxes. Tax deferral strategy for real estate investors, for example, selling a rental property and buying another property of equal or greater value under a 1031 exchange enables tax deferral. This allows the investor to continue growing their investment portfolio without the immediate tax burden, making it a strategic tool for wealth building. Real estate or stock market, which is the better investment? This question comes down to your personal financial goals and risk tolerance. If you value tangible assets, steady cash flow, and long-term appreciation, real estate may be the better option. However, if you're looking for liquidity, diversification, and the ability to trade quickly, the stock market could be more suitable for you. Evaluating investment preferences. The decision between real estate and the stock market largely depends on individual financial goals. Real estate may be ideal for those looking for long-term growth and less volatility, while stocks are often suited for those seeking higher returns in a shorter time frame. Factors to consider: consider your risk tolerance, investment timeline, and need for liquidity. Real estate is typically more hands-on and requires greater upfront capital, whereas stocks offer easier access to diversification and can be bought and sold quickly. Real estate versus S&P 500. A long-term comparison. The S&P 500, which includes 500 of the largest publicly traded companies in the United States, has been a strong performer over the long run. Historically, it has returned an average of about 10% annually. However, real estate often outperforms the S&P 500 in certain economic conditions. Real estate can provide both capital appreciation and cash flow through rental income, whereas the S&P 500 is primarily driven by stock price appreciation. S&P 500 strong historical performance. The S&P 500 has historically provided an average return of around 10% annually, largely driven by the growth of large-cap companies. However, while stocks in the S&P 500 may provide solid returns, they often lack the predictable cash flow that real estate investments can offer. Real estate outperformance in specific markets. In contrast, real estate often outperforms the S&P 500 in specific conditions, particularly in prime locations or during periods of strong economic growth. Real estate investments can provide both appreciation and consistent income, which is an attractive combination for long-term investors. Real estate with God, aligning investments with your values. For those who incorporate spirituality or faith into their investment strategy, real estate with God may refer to making investments that align with their values, such as purchasing properties in underserved communities or investing in projects that aim to provide affordable housing. Ethical and faith-based investing. For those who wish to integrate their faith into their investments, real estate provides opportunities for ethical investing. This could mean purchasing properties in underserved areas or investing in projects aimed at affordable housing and community development. Real estate as a tool for positive impact. Investing in real estate with a focus on social good allows investors to use their financial resources to uplift communities. Whether it's supporting environmental sustainability or improving access to housing, faith-based real estate investing combines profitability with purpose. Real estate to invest in. The best type of real estate to invest in depends on several factors, including your budget, location, and long-term goals. Common types of real estate investments include residential properties, single-family homes, multifamily units, and vacation rentals. Commercial properties, office buildings, retail spaces, and industrial properties. Real estate investment trusts, REITs. If you want to invest in real estate but don't want the hassle of owning physical properties, REITs offer an attractive option. Residential real estate. Single-family homes, duplexes, and multifamily units are popular investment options for generating rental income. These properties are often easier to manage for beginners and provide steady cash flow, especially in high-demand areas. Commercial real estate and REITs. Commercial properties like office buildings, retail spaces, and industrial properties typically require larger investments but offer higher returns. Alternatively, real estate investment trusts, REITs, provide an option for those who want to invest in real estate without managing properties directly. Real estate is an example of physical asset investment. Real estate is an example of a physical asset that offers a combination of income generation, from rents, and potential appreciation, from market value increases. It is a long-term investment that often provides a hedge against inflation and offers tax benefits to investors. Tangible value in real estate. Real estate represents a physical asset, which means it holds intrinsic value and is less affected by the volatility of financial markets. As a long-term investment, real estate tends to appreciate over time, making it a reliable asset class for wealth creation. Hedge against inflation. Real estate is often used as a hedge against inflation. As the cost of living increases, the value of properties and rental income tends to rise, providing investors with protection against inflationary pressures. Real estate without a license. Can you still invest? Investing as an individual. You can invest in real estate without a license, especially as an individual investor purchasing properties for resale or rental. This allows you to enter the market and start building wealth without the need for professional credentials. Becoming a real estate agent. However, to work as a licensed real estate agent or broker and facilitate transactions for others, a license is required. This section discusses the opportunities for unlicensed individuals to invest and the steps required to obtain a license for those interested in working professionally in real estate. In some cases, it is possible to engage in real estate transactions without a license. For example, you can buy and sell properties as an individual investor, or even act as a property manager for your own properties. However, to practice real estate professionally or broker deals for others, a license is generally required. Real estate can be a poor investment if unfavorable market conditions. Real estate investments can underperform if purchased in a declining market, such as during a housing bubble or economic downturn. A lack of demand in certain neighborhoods or regions can lead to stagnant or even falling property values. Overpaying for property. Another risk to consider is overpaying for a property. If you don't account for maintenance costs, repairs, property taxes, or insurance, it could lead to financial losses. Buying at inflated prices or without proper due diligence can turn a seemingly good investment into a financial burden. Real estate can be a poor investment if market conditions are unfavorable, such as in a housing bubble or a declining neighborhood. You overpay for the property and fail to account for repairs, taxes, and other expenses. Lack of cash flow. If rental income doesn't cover expenses, or if you can't sell the property for a profit, it can be financially draining. Real estate for sale in Ohio. Ohio offers diverse real estate investment opportunities, including single-family homes, multifamily properties, and commercial real estate. Cities like Cleveland, Columbus, and Cincinnati have experienced growth in both population and job opportunities, making them appealing for investors seeking properties for sale in Ohio. Investment opportunities in Ohio. Ohio offers diverse real estate investment opportunities, with its affordable property prices and growing job markets. Cities like Cleveland, Columbus, and Cincinnati have seen population growth, driving up the demand for housing, making them attractive for real estate investments. Strong rental demand. Ohio's rental market is also robust, particularly in urban centers and university towns. Investors looking to buy rental properties can benefit from stable cash flow and the potential for long-term appreciation in these growing cities. Are real estate taxes deductible? Yes, certain real estate-related taxes are deductible for property owners. These can include property taxes. Real estate owners can deduct the property taxes they pay on their investment properties. Mortgage interest. If you have a mortgage on the property, the interest you pay is typically deductible. Rental property expenses. Costs associated with managing or maintaining your property may also be deductible. Deductions on property taxes. Yes, property owners can deduct certain real estate-related taxes, including property taxes paid on investment properties. This can significantly reduce taxable income and increase the profitability of owning rental properties. Mortgage interest and depreciation deductions. Mortgage interest is also typically deductible, further reducing the cost of ownership. Additionally, investors can take advantage of depreciation deductions, which allow them to write off the cost of the property over its useful life, offering tax savings while increasing cash flow. Will real estate prices go down in 2025? Predicting the future of real estate prices is complex, as it depends on a range of factors, including the economy, interest rates, and local market conditions. While some analysts predict price corrections in certain overheated markets, others suggest steady growth as demand for housing continues to rise in key urban areas. Factors influencing price changes. While predicting exact price movements is challenging, real estate prices are often impacted by factors such as interest rates, economic growth, and housing supply. In 2025, some regions may see price corrections due to overinflated values, while others may experience steady growth driven by continued demand. Economic factors to watch. Investors should monitor factors like rising interest rates and changes in housing demand, as these can influence property prices. Local market conditions, such as employment rates and urban development projects, can also have a significant impact on future price trends. Can real estate be a side hustle? Yes, real estate can be a lucrative side hustle. Many people engage in house flipping, renting out properties, or becoming real estate agents in their spare time. Real estate can offer flexible work hours and significant earning potential, making it an attractive side business. Real estate as a side income source. Real estate is often seen as a lucrative side hustle. Whether it's buying properties to flip, managing rental units, or becoming a real estate agent, there are various ways to get involved in the industry without committing to it full-time. House flipping and renting properties. Flipping houses or renting out properties can provide flexible hours and significant earning potential, making real estate a popular option for those looking to supplement their income. This section will explore how to get started in real estate as a side hustle and the best strategies for success. How real estate works. Real estate works by facilitating the buying, selling, and renting of properties. The process typically involves property selection, finding a property that suits your budget and investment goals. Financing, securing a mortgage or financing option for the purchase. Transaction, completing legal paperwork and transferring ownership. Management, managing rental properties, dealing with tenants, and maintaining the property. Finding the right property. The process begins with selecting the right property based on your budget and investment goals. Whether it's a rental property, a fixer-upper for resale, or a commercial building, thorough research is crucial in identifying the best opportunities. Financing and legal transactions. Securing financing is the next step, whether through a traditional mortgage or alternative financing. The legal process involves paperwork, contracts, and closing procedures, which need to be handled carefully to ensure a smooth transaction. Once the property is purchased, managing it effectively is essential for long-term success. Why real estate can be a bad investment. High maintenance and operating costs. Real estate can become a poor investment if ongoing costs such as maintenance, property taxes, insurance, and unexpected repairs outweigh rental income or capital appreciation. Neglecting to factor these into your budget can lead to financial strain. Risk of low cash flow or depreciation. If the property doesn't generate enough rental income to cover its expenses or fails to appreciate in value, it could result in negative cash flow. This makes it essential to conduct thorough due diligence and buy properties in strong, growing markets. Who owns real estate? A diverse ownership landscape. Individual and corporate ownership. Real estate ownership is diverse, ranging from individual homeowners to large corporations. Individuals often own single-family homes, while institutional investors such as pension funds, private equity firms, and real estate investment companies control large commercial properties. Government and non-profit ownership. In addition to private owners, governments and non-profit organizations may also own real estate, particularly in the case of affordable housing, public buildings, or land for development. This section will explore the different ownership structures and how they influence the market. What real estate agents do, key responsibilities and skills, guiding clients through transactions. Real estate agents help clients buy, sell, and rent properties by providing expert advice on market conditions, pricing, and financing. They handle the negotiation process, ensuring both buyers and sellers achieve the best possible deal. Marketing and listing properties. Agents also market properties through listings, open houses, and advertising. They coordinate showings, write property descriptions, and advise clients on how to prepare their homes for sale to attract potential buyers. When will the real estate market recover? Economic factors behind recovery. The recovery of the real estate market is closely tied to economic growth, interest rates, and consumer confidence. Analysts expect recovery in some regions by mid-2025, driven by economic stabilization and improved housing demand. Regional variations. Recovery timelines will vary by region. While some markets may experience quick rebounds, others may take longer to recover due to regional economic conditions or housing oversupply. Real estate prices are dropping. What's causing the decline? Interest rates and economic slowdown. Real estate prices may drop due to rising interest rates, which can increase borrowing costs, leading to decreased demand for properties. Additionally, an economic slowdown or recession can reduce consumer spending power, further impacting property values. Market adjustments and regional variations. Oversupply in certain regions can also cause prices to drop, as demand fails to keep pace with the available inventory. Understanding local market dynamics is essential for navigating these downturns and identifying opportunities for investment. Conclusion: real estate continues to be one of the most popular and reliable investment avenues for individuals and institutions alike. As we look ahead to 2025, the landscape of real estate investment remains dynamic, presenting both opportunities and challenges. The strategies and insights discussed throughout this article highlight the key factors that can contribute to maximizing returns and ensuring long-term financial success in the world of real estate. One of the major advantages of real estate investment is its ability to generate consistent cash flow, particularly through rental properties. This steady income stream, combined with the potential for property appreciation, makes real estate a compelling choice for investors seeking to diversify their portfolios. Unlike the volatility of the stock market, real estate offers a tangible asset that can provide security and stability. However, as with any investment, the success of real estate depends largely on the investor's ability to select the right properties, understand market conditions, and make informed decisions.